Let's talk to Jeremy Stretch. He's the head of G10 FX at CIBC. Very good morning to you,
morning,
Jeremy.
Nick.
Right, trade wars. What does that mean?
Well, of course, I think we can safely say that if we are on the precipice of a trade war, then we can safely say that the global synchronized recovery that we've been banking upon could be detrimentally impacted. Now, of course, at the moment we're talking about potentially aluminium and steel tariffs, and we don't know whether they will be imposed and how broad-based those tariffs will prove to be in terms of countries. But ultimately, of course, it's the retaliatory impact of that I think is the greatest concern. And then, of course, we then, as I say, start to get into a presumption of slower global growth and or potentially higher inflation. Not a particularly policy perspective to invade.
So would that, by default, lead us into a recession?
I don't think we're looking at anything of that sort of magnitude yet. I think it's fascinating that obviously in the context of President Trump, there's certainly a lot of parallels, a lot of debate as regards whether he's going to be rather like Reagan in terms of a great tax cutter and reformer. Well, of course he's cut taxes, but he's probably not going to be the great reformer, and the tax cuts aren't as big as the early 80s. But in a sense, is he going to be more like Reagan, or is he going to be more like President Hoover, who of course in the 1930s signalled and signed up to the Hoots-Smalley tariffs, which of course precipitated the Great Recession. So in a sense, which direction are we going? Well, I don't think we're talking about a recession risk yet. I think the worst case scenarios are off the table, but nevertheless, we are heading towards a lower trajectory of growth, which of course is something which we would be, we've seen as very much a retrograde step, because of course, in a sense, we're going back to the fears that we had in 2009 that we would be heading towards trade wars, and of course that means lower growth and lower incomes for everybody.
Okay, so part two of that question, you're obviously talking to clients all day long about the majors. What's driving the currencies generally at the moment? Is it supply and demand? Is it valuations? Is it politics?
Well, politics, I think, is the one of the overarching issues. You cannot get away from that. And of course, coming from a Canadian bank where NAFTA has been a very heavy topic of discussion, then clearly that comes back to the politics. And of course, being here in the UK, you have the Brexit debate. So you have a lot of political risk. You have a lot of uncertainty, which is impacting business investments and business decision making. So that's really causing some degree of consternation. And then the other variable, which I think is still very much in mind, is where is monetary policy going globally? Well, we know we've got a pretty good idea of where the Fed is likely to extend its monetary tightening trajectory. Where else should we be considering or worrying about the prospect of higher interest rates? And that, I think, is the other variable in play. So I think from the bigger picture story, we still anticipate the US dollar will continue to cheapen. And the question is which currencies are going to potentially gain traction on the basis of their central banks being forced to consider some degree of monetary tightening.
So if I gave you Mr. Carney's shoes for the rest of the year, what would you do?
Well, I think in the current environment, I think it's very difficult for the bank, I would suggest, to actually consider tightening rates in the context of the uncertainty in relation to the Brexit negotiation process and the apparent deceleration in the economy into the beginning of this year. We're seeing evidence from the housing market that that's decelerating quite significantly, and that that fall in prices and price expectations, I think, is going to follow through into lower mortgage approvals, and that has a knock-on effect into the economy. So I think the market, for me, is overstating the risks of a May rate hike, unless, and there is an important caveat here, unless wages materially move higher. Now, unless we start to see wage settlements significantly in excess of 3% in the first quarter, then I find it very difficult to argue in favour of a rate hike at this point. I think you can maybe get a case for a rate hike perhaps by the end of the year, but only, and it is importantly only, if we see some degree of movement or pragmatism in terms of the Brexit negotiations. Okay,
so I've read the FT every Saturday since I was a kid, and a lot of fund managers and hedge fund guys have said cable is impossible to trade. I look at the chart, I think, goodness gracious me, I don't know if I'm a bull or a bear. Okay, the technical analysts last year got it dreadfully wrong, who came on to the show. Some of the fundamental guys absolutely got it spot on. Okay, how on earth can you basically rationalise cable at the moment?
Well, it is a remarkably difficult pair to trade because, of course, that political risk is exceptionally large. So you have the Trump issues on the one side, and of course you have the ongoing Brexit headlines and headwinds on the other. So it does make the currency pair very headline driven. You can argue that there's sort of a fundamental valuation perspective. Pre-Brexit vote, I would have said 140, 160 was the sort of the bigger picture valuation range. Post the Brexit vote, I would have lowered that to maybe 120, 140. Now we've moved through that first phase of the negotiations in terms of withdrawal. I guess if we're within a 130, 150 range, we're probably not materially mispriced. But that is a 20 big figure range, and so that makes it very difficult. I think in the context of trading sterling, actually, I think you probably want to avoid cable and probably look more at euro sterling. I think that's much more of a directional basis in terms of the stance of the negotiations between the UK and Europe. And I think that's probably a better way if you want to look at sterling action and trying to trade the Brexit process.
Right. And finally, as always, got to ask you, what's your favourite pair at the moment in terms of on the bull or bear?
Well, I think it's very difficult to have one specific pair, but I think you probably want to be looking at a basket of perhaps some of the currencies which have come off quite hard. So I think the Aussie and the Kiwi, I think, have probably moved too far. I think the Swedish krona as well has also sold off a little too aggressively. So I think in a sense you want to be looking at those which have sold off very aggressively, looking for opportunities to see rebound in those, because I think in all of those three jurisdictions, monetary policy expectations are too low, and I think the markets will be forced to reprice those, and accordingly we will see those currencies appreciate.
Jeremy, as always, thank you very much.
Thanks very much.